Friends, welcome to Yadnya Investment Academy. Before we begin, we want to let you know that Yadnya Investment Academy has come up with its first book, which is a collection of 108 questions and answers on mutual funds and SIP. The book is available on Amazon, Flipkart, etc. and the link to buy the same is mentioned in the description of this video. So now, let's move on with our topic. Through your comments, we got a lot of questions like what is an expense ratio, how is it charged, how does an asset management company make money, etc. And so, we thought making a video on expense ratio is something that is required. Expense ratio, or something also known as total expense ratio, is the fee charged by the mutual fund for managing investor money. This is a single fee that includes all the expenses required to run a mutual fund, like a registrar fee, fund management fee, distributor's commission, advertising expense, auditor and custodian's share, etc. Expense ratio is charged as a percentage of your assets under management. It is expressed as an annual figure but charged on a daily basis. NAV in case of mutual funds is calculated after deducting the expense ratio. That is all the expenses related to running a mutual fund. So NAV based returns that you see in case of mutual funds are your actual returns. Unlike ULIPs, wherein NAV is calculated only after deducting the fund management charges, and then onwards, a huge array of charges is levied, which is recovered by deducting your units. So NAV based returns in case of ULIPs don't give you a clear idea of the kind of returns you've earned, while NAV based returns in case of mutual funds are your actual returns. Let us take an example to understand this. Let us say you invested 1 lakh rupees into a mutual fund which had an expense ratio of 2%. So in a year, you're paying 2000 rupees to the mutual fund for managing your money. Or you could say, in that year, if the mutual fund earned 10% of returns on your investment, it would keep 2% to itself and would pass on the remaining 8% to you. But remember, expense ratio is recurring, and irrespective of the fund makes profit or loss, expense ratio would be charged. We have been continuously saying mutual fund industry is one of the most transparent, most well-regulated industries, and the same is evident from the way expense ratio is charged and how things are kept transparent through the NAV. Stock Exchange Watchdog SEBI has put ceiling on the amount of expense ratios that can be charged. For equity mutual funds, it is 2.5, and for debt mutual funds, it is 2.25. Mutual funds can take an additional expense ratio of 0.3% if 30% of their inflows come from cities and towns which are not a part of the top 15 locations in the country. This incentive has been given so that mutual funds try to penetrate smaller cities and towns. Expense ratio is charged as per below slabs for assets under management. In case of equity funds, the first 100 crores of assets under management are charged at an expense ratio of 2.5%, the next 300 at 2.25%, subsequent 300 at 2%, and the remaining at 1.75%. In case of debt funds, the first 100 crores of assets under management are charged at an expense ratio of 2.5%, the next 300 at 2%, subsequent 300 at 1.75%, and the remaining at 1.5%. Now, this doesn't mean that the investors in the first 100 crores are charged at an expense ratio of 2.5%. These are weighted average figures, and every investor is charged equally irrespective of the time when you invest into a scheme, whether you invest into an NFO or an already existing one. The mutual fund has the right to change the expense ratio over a period of time but would still stay under the ceilings imposed by the SEBI. Newer funds would generally have a higher expense ratio than the older established ones. So should you care about expense ratio in mutual funds? In equity funds, the good funds would give superior returns than the average ones, and the difference between the expense ratio would not be much. In that scenario, you should select funds that give you superior returns. But if you're considering two funds for investment which are same in all aspects like returns, risk return parameters, etc., but only differ in terms of expense ratio, you should choose the one that has lower expense ratio. In case of debt funds, performance, that is returns in every category, are generally similar. So expense ratio becomes a differentiating factor. After comparing returns within a category, you should go for a fund that has a lower expense ratio. There are direct and regular plans of the same mutual fund, where regular funds have higher expense ratio as they come through distributors, and a portion of the expense ratio compensates the distributor for his advice. Direct plans have comparatively lower expense ratio as there is no intermediary involved, but you should go for direct funds only when you are an experienced investor and do not need an advisor per se. So friends, in this video we have seen what is an expense ratio, how NAV is calculated after deduction of the expense ratio, how NAV based returns are your actual returns, what are the various ceilings on expense ratio in case of equity and debt funds, whether you should bother about expense ratio in case of mutual funds, and what is the difference in expense ratio in case of direct and regular plans. Hope the video has been useful. Thanks for watching this one. Watch this space for more such topics. Until then, happy investing.